Welcome to the First Customers Podcast. Today we have Dan French with us. He's the CEO of ATX Acquisitions. They invested $2 billion in asset value across 17,000 apartments and returned $1 billion in revenue to investors. Super excited to have you on the show today, Dan. Thank you for being here.
Yes, I'm excited to be on. I'm a big fan of your show, so happy to be here.
Awesome. All right. So you've had a lot of success in the real estate game. Tell us how you got the first customers for ATX Acquisitions.
Well, I thought it might be perhaps more interesting to go into when I first invested in real estate, like
Sure.
20 years ago, right? So,
Yeah.
and because it's more, ATX Acquisitions buys bigger assets, and it might not resonate the same way with folks, right? And we have
Okay.
a property management team that we work with, and they handle a lot of that day-to-day stuff. But when I was first investing in real estate, it was a 4-unit building. Basically, is how I got started with my business partner Pete Rex and his brother, and I really self-managed that property. So I think that's kind of interesting for folks that are looking to do something on their own, maybe on their own personal account, like buy their own piece of real estate, because a lot of folks have that in their heart, right? They want to build generational wealth, and that is a great way for some people to do it, right? Some people want to be active, and that's what I would call active. Like, you actively manage your own deal, you put together the deal, maybe you use your own you are the guarantor of that deal, right? You're on the hook to the bank. Now, some other folks want to do passive investments, and that's what ATX Acquisitions offers people.
Okay.
Right? So we offer passive investment to build generational wealth. But if you want to go more active, I just think that that's an interesting story about my first customer. So if that's cool, I'll start off with that, and
yeah, that's great.
That's a grind of look, you have 4 units and you have debt on this building. And so that means that every dollar really you need to bring the dollars in. And so there's no one else backstopping you. And that's how we started off, like bootstrapping. And really, like, didn't have a lot of capital reserves, had a lot of debt on the building. And so finding your own customers, like, I remember back then we used Craigslist to go find people, and where I would just do things that were really scrappy. And this is like a good lesson for, I think, anyone out there. Like, you have to really, if you're gonna do something active in real estate, be prepared to get super scrappy. And that's what I remember doing, is like, even there's a bar next door to this property, like very nearby. Just putting up flyers around that bar and around, like, the local coffee shop, talking to different, or getting into channels around the local college that was nearby.
Is that just to keep tenants interested in the property?
Leased apartments, right? And then doing your own leasing tour, which, if you've never done it and then all of a sudden you're doing it, there's a way to sell and there's a way to come across, and there's, so I think that's what I think about when I think of my very first customers in real estate. It's like, and I also think about vendors being a sort of customer in real estate.
Okay.
So to get our apartments functional and working, or to do like a unit turnover is what they call that. So if someone vacates an apartment, you need to get that thing, in running order. You might have to paint it and do some minor fix up. But you need great vendors to do that. Otherwise, your revenue gets shut down. You can't sell your apartment. So I think even doing scrappy things, like, we would find vendors just they're doing work in the local area, and you stop them and say, hey, what are you guys up to?
Yeah.
Do you want to also work for us? And that's how we found our very first, like, key vendor. I was literally just stopping someone who was doing work in a nearby building and just talking to them. So these are the kind of scrappy things that I think you got to be prepared to do if you're bootstrapping in real estate, and many people are seeking to do that. So
let's back up even more then into that first deal. And because I think, a lot of people are interested in real estate, think about owning property, or, like in my case, we were buying a house and then we moved, we rented it out afterwards. I think that's something that can happen. But get into, like, what were you doing when you decided to invest in that first 4-unit rental property, and how did you actually get the funding, or, what I mean? Kind of some of the logistics of how it actually happened.
Yeah. So, credit to, I had a small, it was basically, we looked at it like a small partnership, right? Myself, this guy, Pete Rex, who I'm still business partners with, even right now, 20 years later, same guy. and his brother Rob. Now I grew up with these people, right? So I had deep knowledge of what kind of character they had, what kind of work ethic they had, what kind of people they were, and so credit to Pete. Really, he was the one that really approached me and said, "Hey, I'm thinking about going into real estate. Would you want to be involved?" And I immediately said yes. And back then, this is 20 years ago, I was pursuing a different career, honestly. And this might resonate with some people too, is like, real estate, if you have it set up well, you can pursue one passion, right? And then real estate is another passion, and you can use it to build future wealth. That was my idea, right? Is like, yes, Pete, I'm all in. I want to do this. I'm like 24 years old, thereabouts. And I wanted to get involved, and at that point it was like 2005. So this is a period of time when a lot of people had the same idea, like, if I just own a piece of real estate, I'm going to be great. It's just always going to go up.
Yeah.
And so we just put together a deal by working with banks, doing some creative sort of lending where you get more leverage than you can get nowadays, right? The banking
because that was before the
world is
collapse
totally
in
different.
2008.
It tightened up big time.
Yeah.
So prior to that, you can do more creative things and get
What do you
higher
mean by
leverage.
creative things?
Simply more high leverage.
Okay.
That a bank the banks were more open to doing this.
Okay.
And nowadays is much more strict requirements of like loan to value, loan to cost.
Okay. So you could have a lower down payment for way more. They'd finance way more, higher percentage of the debt.
Yep. So you can scrape together some equity, right, to have in the deal, but you don't need as much. And that makes the deal more risky, right? Which we've very quickly found out. And many people that went to the great financial crisis found out the same thing. And that's why, we made a lot of mistakes here at early days in real estate. And one of them clearly is don't over leverage. Because then you get ahead of yourself. And if the market changes and you can't fill your units, or people are not paying, you need to evict them, which is a very real thing that happened to us. You get in trouble really fast because every single dollar is much more meaningful in paying down your debt.
Right.
Yep. So that was how that whole journey began. And my real passion at that point was to go into public service, which I did. And it was a few years later that I went to real estate with my full heart, mind, soul, effort.
Okay.
I've been in real estate for 20 years, but in the early part of that, I was chasing an idea to go into public service, which I executed on and became an elected official. I was an elected official for 7 years. So.
Oh, cool. What kind of office?
Councilman, and then I became a town supervisor. It's like being a mayor of a small town. So when I was 23, I became a councilman. 20
That's cool.
28 became like basically the equivalent of a mayor. But it's just part of the journey. I don't know if
Yeah, it actually, I think, complements real estate pretty well, being in the kind of politics of a local area, especially if that's where you're wanting to invest, because you get what could be called insider knowledge on what's going to happen where, in the city. You're the first one to know because you got to approve.
In my case, I wasn't investing in within the town that I was serving, but people do that, and so that really kicked off my journey, Paris. That was that hands-on, very, very personal interactions, renting my own units and handling maintenance and handling unit turnovers. And unfortunately, I've stood in court and done my own evictions, just to save money on an attorney.
Wow.
That's how tight it was. So yeah.
So what was that? I was going to say, what was that initial deal that you and that first partner worked out? Like, what were you responsible for versus them, or was it just you putting money together? Or
I wish we had like a more roles, responsibilities, and expectations, which we're pretty advanced now in our careers, and we always have like some kind of like REs, we call them roles, responsibilities, expectations. But at that point, it was a little bit just like, let's get together, let's do this, make moves. Like, we're young, we're entrepreneurial, we want to make things happen. So, but broadly speaking, Pete was the one that was really driving, putting together the deal, sourcing it, figuring out how to capitalize it. And so credit to him on being like that mover that was like pushing us to get the deal. And then I was more in the beginning kind of handling the day-to-day ops.
Gotcha.
But
Okay.
getting, there's overlap on everything. When it's a small partnership, you just kind of do what you got to do.
Right.
Yeah.
Okay. And did you have to put up any of your own money, either one of you, or did you get it completely pretty much financed?
No, we did. We put up our own money. There was some equity in there for sure. And then
Yeah.
as we went on, we did some small, like, friends and family type amounts, type of capital that we raised.
Okay.
Yeah, but mostly just bootstrapping, making things happen. And I was taking like personal recourse on the loans, which
Right.
can be scary.
Yeah. 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 All the risk, but it
Yeah.
sounds like it. Did that property pay off and you held it over time, or do you still own that original?
Don't still own it, no. But I would say that whole period between '05 and 2010 or 11, it was just didn't make any money. That whole period, and we did pay all of our small investment partners that came in with us, like friends and family. They got paid back, but we as a partnership didn't make any money, which is kind of wild.
Did you pay
And
them
but
back after selling the property, or just through the revenue over time?
we had to recapitalize some stuff, and there was different ways we paid them back from future earnings and whatnot. But just to make
Okay.
good on them betting on us was
Yeah.
important to us as a partnership team. And so that whole period was like a lot of blood, sweat, and tears without any payout. But then later on, between 2011 and 2019, that's when we bought $2 billion of assets.
Yeah.
Betting, taking all those learnings. So it's tuition. If you do it right,
Yeah.
you get your head kicked in a little bit, but it's tuition for the future, and it's one of the best ways to learn, right?
Yeah.
That's what a lot of people are trying to figure out. Like, how do I do this? Well, one way
Right.
is just to just go in and start. Do something, because you're going to take some hits.
Yeah.
There's no one, I think, that's had a perfect career in investing in anything, but certainly
Right.
real estate. You got to just go in there and try to be downside protected and be smart, but get started.
Yeah.
Yeah.
So did you start like an LLC or something at the beginning that people were investing in to where they were part of the company growth, or was it just this deal? Just kind of
Just
this.
just deal by deal. Yeah,
Okay.
it was pretty simple.
Gotcha.
Yeah.
Okay. Yeah, I think that's interesting how things get structured, and it sounds like you guys were just 100% action, making stuff happen.
Yeah, it
And
really is. And we had such high trust between
yeah,
each other. We had known each other since grade school, like 7 years old. So we had a lot of trust built up.
yeah, that's
But
awesome.
even with all that trust, when you go through difficult times, it gets tested.
Right.
And luckily our team is one that made it through together and still kept our friendship intact, kept our partnership intact from a business standpoint as well.
And you guys are still partners today?
Yeah, I'm full time with Pete. I've been
That's
full time
awesome.
with him been investing with him for 20 years, but full time with him for over 12. And Rob he's amazing as well. Our other partner, his brother, but he's now doing his own career in media, actually. So he's still
Okay.
a partner in our former company, but he's pursuing a passion to do children's media. Yeah.
That's really cool to hear about
Mhm.
a long-term partnership like that with lifelong friends. That's really awesome. So you said you didn't make any money kind of that first round.
Mhm.
What was that next project or deal? Did you work on new deals during that first kind of deal's lifespan? Were you like, hey, we're still gonna do more real, like, talk about a little bit of that, not getting discouraged, because if you're not making money on that deal, what made you guys keep going forward?
Well, we kept going forward, and we bought a lot of these 4-unit type buildings, small
Okay.
deals, right? And before you knew it, I think I don't remember the exact unit count, but it was like maybe 100 units total
Whoa.
of all this
Okay.
small stuff. So we kept going prior to the run
All
up
right.
all the way till, like, let's say 2007, 2007, and then it's when where the shocks of the great financial crisis began to be felt. That's when we were like, oh, You know,
Yeah. Okay.
we're gonna get in some. We're gonna get through a little storm here.
So you were doing that style of real estate investing where you're leveraging everything you just bought to buy something else, kind of
Essentially,
stacking it
yeah.
up.
Just let's go. Let's get it. We're very
Okay.
acquisitive at that point. Like let's just acquire deals and try to run them as best we can. It worked for a while. We thought we were on top of the world, and then of course, like many people, the market changed really fast, and it
So
unraveled really fast.
thinking about the 2008 housing crash, but if you're investing in rental properties, like people still have to live places. So what was it that negatively affected you guys? Was it the type of loans that you had that got affected, or was like what was it? Because it seems like people are still going to be living where they're living. So why wouldn't you just still be making money if everybody's still paying rent? Or
Well, a couple things. One is that we wouldn't really invest in the same area that we were in at that time, right? So, and even from a neighborhood standpoint, so these are like transitional type neighborhoods that weren't the greatest. So some of these folks are like they're already, and many today is very sad, even in America, the wealthiest place on earth, right? Many people are living paycheck to paycheck,
sure,
and that's a reality. And in one medical emergency, and they can't pay the rent, and
yeah,
it's crazy and it's sad and something we should change as a society. But so couple that sort of paycheck by paycheck type renter, right? If something goes wrong and unemployment is now double what it used to be just six
gotcha.
months ago, like it's going to hit some of those people the hardest.
I
So
see.
we were in the class of housing that was like hardest hit in a neighborhood
Okay,
that didn't have that much resilience. So
so
these are
this would
lessons you
be
learn, right? Like
right.
now we want to bet on a neighborhood that's going to be durable, whether it's good times or bad times, and to do what you're saying, like, all right, don't people need to live somewhere? Yes, they do,
Right.
but
Yeah.
some neighborhoods are more resilient than others.
Yeah. So that seems like you must have been in this in between layer, almost middle class rental housing, because like if you think Section 8 or like government funded properties, like you get paid regardless, right? If the renter pays or
Yeah,
not. So you weren't doing Section 8. It sounds like you were doing a little bit higher level income properties than
we
that.
probably had a handful of that, but not
Okay.
all of it for sure. So then above that, it's like more workforce housing,
Yeah. And they
working
get hit
class
the
type folks.
hardest, unfortunately, it seems
They
like.
do, yeah,
Yeah.
for
That's
sure.
rough. Okay. So you weathered the hard times there during the housing crisis. And so did you have to like reset and like did you hit it like a bankrupt type spot or have to sell everything, or how did you make it through the hard times?
No, we avoided the worst of everything, and again, credit goes to Pete, and we just stuck together. We stuck on it, and a lot of the banks didn't want to take over the properties, right? And actually, a lot of them had traded in and out of, or they had gone bankrupt themselves. So private equity groups began to buy different banks. It was really hard to know even who owned some of the notes that we had. So we just had
Hmm.
through perseverance, we worked it out with all these different groups, and we restructured things, and then we just lived to fight another day, and we
Wow.
kept running the properties and doing the best we could. And so through a lot of perseverance, we had to unwind it and work it out, but we did over many years.
What makes you decide to sell a property?
Nowadays,
Sure. Or like that first one that you bought, like why did you sell that one? And then maybe relate that to why you would sell something now.
well, in the early days, it was more about just getting out of, if you, what's this, the saying is like, if you're digging a hole, like the first thing is like, stop digging. So you just want to, it's like,
Okay.
it just felt like, hey, let's get just a price where we can make sure the banks are on board with it and pay them off and everyone's okay.
So it wasn't making
And
enough profit or any profit, or maybe you're losing money on that specific
yeah, let's at least just
property.
clear the debt. You know what I mean? And not imagine a future where, oh wow, some magical day is going to come where we're in the money again and going to be making all this money off this deal. Let's just make sure we can exit.
Okay.
So,
So would it be
but
like the
that's a totally
performance?
different. Yeah.
I was going to say, is it like more the performance of the actual like how the tenants are performing every month, how reliable they are, or is it like the initial deal wasn't as in your favor as maybe you wanted, like the financing side, that initial when you made that deal?
Yeah, it would be a combination, right? So this
Okay.
is back in the day. First of
Yeah,
all,
yeah.
this is how my mindset was back then. So one is performance. Can it cover its debt? Number
Right.
one. That's number one. You have to. If you can't cover your debt, you're in real trouble. And we see that nowadays, right? With some of these groups that bought really high and now they have floating interest. They can't even cover their debt. Okay, that's things are bad when that's happening. So number one, how's it performing as an asset? Is there actual net operating income? Does it cover debt? But then it's about location. You know,
Okay.
how much do you like this location? Is it something you want to bet on?
Interesting.
Is it gonna get better? So those are the two main components.
Okay.
And then location, it pulls in all kinds of data, like how much new supply is in the area. How much, which dictates how much can you push rent, how much capex is needed to keep your asset running, and not, because every asset's deteriorating, right? As you go, there's a
Right.
useful life of everything on a deal, so it constantly needs to be replaced. So there's so many, as a plurality of things we'd have to look at to
Yeah,
say,
yeah.
like, hey, let's sell this one.
Gotcha.
It's fairly detailed, but
So have you found that you guys are starting to consolidate into um, less locations so that you can kind of get some of that synergy of, all your vendors and your services that you need, or are you still spread
yeah,
out and just looking for the best locations anywhere?
not quite anywhere, right? But so just the happy part of the story is that from 2011 to 2019, that track record's awesome. I
Yeah.
think it's top 25% of any group that started off in a similar time frame. So 22% net IRR returns that to our limited partners, and over a 2x equity multiple over doing 100 deals. So 17,000 apartments. And what happened there was we focused primarily on Florida and Texas.
Gotcha.
That was our thematic bet, was that Florida and Texas, after the great financial crisis, was going to do great. And that turned out to be a really strong bet.
Especially, yeah, because it lined up with the places that did the best after COVID as well.
Fair. Yep, exactly. So we continue to bet primarily in Florida and Texas. And
Okay.
these are states that are business friendly. There's no state income tax. And as a result, you're seeing, massive job growth. And then, of course, population growth closely tracks your job growth. So these are places where people want to live,
Yeah.
and that is having amazing net immigration. So Texas, you look at corporate relocations, so many happening all throughout Texas.
Right.
The big names, of course, we all know, of course, Tesla and what Elon Musk is bringing to Austin, Samsung, just all these different groups
Right.
that are betting on Texas. Look at Dallas, has had so many. And then Florida is this migration also of just net worth. So people that retired go to Naples, they go to Boca. They're
Yeah.
bringing so much of their net worth with them, and it has reverberating effects on the economy. And of course, they're growing jobs in Florida too.
Yeah.
So these are two amazing states. If they were their own nations, Florida would be in the top 20,
Wow.
and Texas, I think, would be number 7 if it's its own nation. And
It seems like some people in Texas want that.
yeah, they're ready, man. They're ready. If they need to, they're ready.
Right. That's crazy. Number 7. Yeah,
Yeah,
that's wild.
it's an economic just powerhouse. It's a miracle.
Right. That whatever the triangle, San
Mm-hmm.
Antonio, Houston, Dallas, and now, yeah, Austin blowing up in the middle.
Yeah.
Yep. All right. Um, so let's say there's somebody wanting to get started in real estate and kind of get those first customers in the form of whether it's investors or the bank or tenant. What would you advise somebody who is wanting to get started now in today's environment?
Yeah, look, I would say you have a couple things you need to decide. Number one is, do you want to be active and put together your own deal? And maybe that means, buying a single family home somewhere and renting it out as an Airbnb, right? Or renting it out as a single family rental where you have like year-long leases as you go. That's a different beast. That is more active. even if you have a property management company that sort of like you're paying them to take that work off your hands, you still have to oversee them directly. And it's much more active. And chances are that might be you might need to put up like a personal guarantee for that.
Yeah.
So you as an individual is on the hook for that deal. That's how many people kind of do this. So that's one thing. Or you can be a passive investor. You can invest in a group like ATX Acquisitions and
Gotcha.
learn as you go and track our deals and the deal you're in. Maybe you're in multiple deals with a group like ours, and you get to know, all right, this is how the deals are unfolding. This is what this group looks at, how they're looking at how to underwrite a deal, what markets they like, and then when we buy a deal together, you're getting the quarterly reports. You're understanding how performance is tracking against what we expected it to do. So that would be one question I would have for you. Are you active or are you passive?
Gotcha. So with your deal, is it kind of like a fund, like in the stock market, you invest in a ETF or whatever, an exchange traded fund, and you give them your money and they decide what stocks to invest in? Is that kind of what you're saying that your company does, where somebody invests in your company, or however you phrase it, gives money to your company, and then you guys decide what deals go into it, or does the person like actively choose which deals they want to be involved in?
Yeah, great question. And it's actually both. You can choose to do either.
Okay.
So for our team, at least, what we put together is called a general partner fund, or GP fund. So if you are an investor who wants to just get more diversification and you don't care about picking individual deals, you just want to sign up for the fund, and thematically you agree with us as a sponsor, and you agree with our thesis, which is, we're betting in Florida and Texas primarily, or high growth states, population growth states, and we're betting that the interest rate dislocation, the rapid rise in interest rates is causing massive dislocation, which equals buying opportunity. That's our broad thesis. So if you agree with that broadly and you want to go put your money in a diversified kind of basket of properties, so the fund will buy, let's say, 10 to 12 properties.
Mm-hmm.
That's one option. Or the other option is that you might want to look at each deal by deal, and say, oh, you know what, just show me a deal when you have one in Texas only. Because I like to invest where I live. I live in Texas, and I want to be able to drive to my properties. So don't show me Florida deals. And at that point, you can invest in an individual deal. So maybe you put $25,000, $50,000 in an individual deal. You might do that 2 or 3 times, and then you're only in that specific deal. Do you know what I'm saying?
Yeah. Okay. Yeah. So that way you guys do all the admin and all the deal finding and all that, and then
we serve you. You're our partner. We serve you, and we get paid when you do well. That's it.
Okay. So right now I'm personally in that, I guess, active category, where the past 2 times we've moved, we just turned our houses into rental properties. So now we've got 2 single family rental properties. It's like, oh shoot, we got a little real estate business starting to grow here.
Yeah, you're a mogul now.
It's on the way.
Yeah.
But they're single family properties, so it's like, the profit margin's not really there per property because it's just one tenant. Whereas, if you're trying to go really turn it into a thriving, growing business, it seems like multi-unit a lot of times is what I've heard is the route you want to go, like what you guys have done. So I guess to balance that, I could say, all right, I could put a little bit with the ATX Acquisitions guys, and then that spreads it out and gives us some passive income. But is it easier from what you've seen? Like once you have a property or 2, like in my situation, is it easier to go to the bank and be like, hey, I want to get another property. Got 2 of them. Give me some money.
That's a good question. I'm not sure if I'm even the best equipped to answer that, because what we're doing nowadays is really 100 unit plus type stuff, and 15 to $70 million deals. So yeah, we put those together, and I haven't rolled up a single family portfolio, but I'm sure I would have to believe that.
I'm coming for you. I'm gonna buy 2 unit. I'm gonna buy 2 unit next.
I'm gonna learn from you, man. You got hey, well, you're betting on yourself and betting on the future appreciation of those homes, and more power to you, man. It's great. It's smart.
So I guess I mean, you guys have huge assets, like you said. It's been like 2 billion in assets now. And is that like how much you guys hold at the moment? Like that much value across your apartments, or
No. So that period of time is when we bought the 2 billion, and then 2019 we did something very, very rare for a real estate private equity firm, which is that we stopped buying deals. Because once you have a deal shop, you tend to just, through inertia, just keep going, just keep buying. And instead, we were much more, I would say, disciplined. And we said, you know what? The market is really quite frothy at this point. So let's sell into this frothy market and then capture all the equity that was trapped in our deals.
oh, that's right. It kind of started to peak at that point, right?
Yeah, yeah, I mean, you could argue, hey, what if we had kept it for 2021 and sold it then? Okay,
Right.
well, fine, but then you have 2 more years of holding it through COVID, which was difficult
Right.
to operate. So
And then the interest rate shot up, so you avoided buying at that
no,
time.
totally. So we sold $1.5 billion basically after 2019, and that's how
Dang.
we locked in that great track record. And it's just being disciplined and understanding, hey, you know what? The play that we showed up for in 2011, 12, 13, even through 2016, 17 is totally had changed because a lot of groups had rushed into the same idea. When we were starting out in 2011, 2012, we were often the first group into neighborhoods and recapitalizing stuff that had been very distressed with the great financial crisis hitting those areas really hard, you know?
Okay.
So we changed our whole mentality and we stopped buying deals, and we were waiting around for a good buying opportunity. And so now we look back and we see a lot of groups during 2021 when debt was basically at zero. They paid a very high basis and they took floating rate debt, which means a lot of groups are in trouble. You know, they're not going to hold on to their deals.
And the floating rate means that when interest rates go up or down, their interest rate goes up or down. So their
Yeah, so
payments go up or down.
exactly. So we think a lot of those groups, and we've already seen it, right? It's already happening in the market as we speak, where they're having to sell, and sometimes even at the cost of their debt. That's it. That's all they can get out. And
Dang.
sometimes I've seen even below, where people are just like, well, you know what? Let's just cut ties with this deal. And that's where a group like ours wants to get greedy during this time. When other people are fearful, we're going to get greedy.
Okay.
Yeah.
Because you sat on the cash for a little while, and so now
Yeah.
you can really pick and choose the deals that are best in your favor.
That's right.
Okay. And so that's a stronger pitch as well to people who are wanting to passively invest with you guys, because you'd be like, hey, we're just investing in great stuff.
And we don't exactly. I mean, look at the track record is probably the best thing that you can do when you're vetting a sponsor, and you know, a lot of groups just want to keep buying just because they want to take fees or they want to, you know, just keep their team busy. But those aren't good reasons to buy. The good reason to buy is align your interest with your limited partners, and you're only going to buy when there's good opportunity. So it's going to be choppy. Like some periods we're going to get more active when we feel like there's a great buying opportunity, and in other periods we're going to get more quiet or almost like do zero transactions. You know.
Oh, that makes sense. And do you focus more on residential?
No, we have a specialty, a really deep specialty within our team in multifamily.
Okay.
You know, apartments, and we know how to do those. But we're right now we're looking actively at different things like triple net retail space, medical office buildings. But we get the most looks in the multifamily space because we have a lot of broker relationships and people that they're excited that we're buying again, so they show us deals. Yeah.
I know, because that's been in the news a little bit, I think, about how like commercial real estate properties are in such a bad spot because of like the remote work movement that exploded during COVID and all that, and you know, not as many people getting back to the office and all that. So it seems like there would definitely be a lot of deals if those, you know, properties are truly hurting over these next few years. But that seems like you guys sidestepped that catastrophe as well.
You know, we never did office investment. We never invested in traditional office deal. You know, we bought a couple office buildings for our own team use, like where we'd actually work from, but that was the extent of it. And I wouldn't really touch office right now.
Yeah.
Personally, as an investor, I don't see it. I feel like this, remote work is here to stay, and
Right.
so we don't even know really where it's gonna kind of pan out. Like how many people are gonna work from.
Right.
How much are groups gonna limit their office footprint? I think is a good way to say it,
Yeah.
because they just don't need as much. So
Yeah. And if AI keeps going the way it is, they won't need hardly any at all.
yeah, no more humans. Yeah,
Right.
it's a bunch of
It'll
AI.
just be server rooms. Yeah.
Mhm.
Okay. Cool. Well, that's a really cool story of going from just a couple of lifelong friends making something happen, turning it into a huge real estate empire. This is really
Yeah,
cool, Dan.
thank you, man. Well, I just feel very blessed that I've had great partners, and and it's very joyful in business when you succeed. It's a lot of fun,
Yeah.
but in business you also have to be prepared for very difficult times, and I've seen that too. So,
Right.
but it makes you more grateful for the good times.
For sure. Would you recommend any books to people interested in getting into this kind of a business?
Look, I love Warren the Warren Buffett shareholder letters, really Berkshire Hathaway shareholder
Okay.
letters. They're a little bit difficult to get through, but you can buy like a book form where you can get them all together, and there's over 50 years of them.
Yeah.
And I think that's just such good foundational training about how to think downside protected, kind of be prepared to be a contrarian, you know, just the Buffett mentality, and actually Charlie Munger too, right? Both of them.
Right.
This is so good. So
Yeah.
good. Yeah.
Okay. I'll put that in the show notes. And where would you want people to reach out to you or find you out on the old internet?
Well, we can kick it old school, and I'll give my cell phone number too. So that's okay. No, seriously, if you want to just even to compare notes and say hello to me, it's my number is 845-629-1808. But D French
Wow.
at ATXacquisitions.com, that works too, or just
Okay.
look me up on LinkedIn. I'm fairly active these days on LinkedIn, which has
Okay.
been fun actually. Just started that about a year ago. It's been fun to get on that platform and put
Yeah.
some thoughts out there.
Bold move putting the cell phone out there.
You'd be surprised, man. I've had it out there forever, and this is from my days of being an elected official. I would just always put it out there. You'd be surprised how few people actually use it.
Yeah.
But it's a sign of just like I'm humble. I want to learn from different people, and I like to make connections and
Yeah.
see who's out there.
That's cool. Well, Dan, I appreciate your time today. Everybody reach out, start texting Dan, and
Everyone text me all at once. Yeah,
yeah.
it's gonna be great. Yeah.
But yeah, thanks again for being here, and we'll see everybody on the next episode of the First Customers Podcast.
Thanks, Paris. Pleasure to be on, man.